Hello guys, welcome back to my channel. This is Gideon Forex Academy. If you are new on here, consider subscribing to my channel. Also check me out. I have a free Telegram channel. Just join. Check in my bio. The link is there. And also like this video. Watch till the end. Today, whether you are just starting your trading journey or you are looking to sharpen your skills, you have got to understand this. By the end of this video, you will know 3 fundamental candlestick patterns that will help you spot potential market reversals and give you the confidence to make way better trading decisions and entries, especially entries. So we are going to look at 3 candlestick patterns. You are looking at a hammer candlestick pattern, all right? So you are looking at a hammer candlestick pattern. It looks like this. So this is the body, okay? And this is the wick. So this is the wick. This long part here is the wick of that candlestick. All right. So it has an opening price. This is the opening price right here. Okay. This is the opening price. Okay. That means the market, this candle opens here. The price opens here. All right. It opens here at this price. All right. But the sellers push that price lower to this point here. Okay. To this point here. But then after the sellers push this, selling pressure pushes this price lower, there is a lot of bullish momentum or buyers come into the market with so much orders that they push the price back up again beyond the opening price to a new higher price. That is the closing price up here. Okay. So that indicates more bullish momentum than bearish momentum. So you have more buying pressure, okay? More buying pressure in this candle indicates more buying pressure than selling pressure, okay? That is why the buyers were able to push this price back up again to this point here beyond or above the opening price, okay? So whenever you see this candlestick pattern, it indicates eminent bullish momentum, especially at support areas. Okay, so take note of that. All right, so let's move. Let me demonstrate it here. If you have lower lows and lower highs, and the market is trending downwards. Okay, so when it gets to a support area, let's say this is our support area. Okay, or demand or support or a demand zone. Okay, so usually when you see this candle, when you see the hammer at support. Let me try to draw that hammer here. When you see a candle like this at support, let's say this is a hammer, all right? I'll just draw it better. Okay. So let's say this is a hammer, all right, at support. So when this candle forms at support, whether it is a blue candle or a red candle, they both indicate a bullish momentum. Only that the blue one or the green one indicates more bullish momentum than the red one, but they both indicate a bullish momentum. All right, the blue one or the green one is stronger than the red one usually. All right, so now you are looking to buy at this point. When this candle forms around support, you are looking for buys to the upside. All right, so you confirm that and place your buy order. You place your stop loss just below that wick. That's that wick of that hammer. That's where you place your stop loss. All right. So that is just an illustration. So as I said, the hammer sometimes can be red or blue or green. Okay, both of them, as long as the structure is the same, they both indicate bullish momentum. Let not the colors fool you. Okay, take a look at this. This is a demand zone. All right. This is a demand zone or a support zone. Okay, we'll just mark it out as support. That's our demand zone. Okay, so we see our first touch here. All right, and that is our second touch. So this is clearly a demand zone. So usually we anticipate after the impulse upward, and we see this retracement back to the demand zone. All right, we anticipate that at demand zone we are going to be buying because there is a reaction at these 2 points here. So we anticipate that there is a demand at this particular zone. There's so many orders placed here. We see that this is a momentary downtrend back to this particular demand zone. So at the demand zone, after this slight downtrend here, okay, we are anticipating to buy around this zone. So we watch price action around this area when it gets back to the demand. All right, so we'll be looking for opportunities to buy at this point. So we are looking for candlestick patterns, all right, to confirm our entry at this demand zone right here. Okay, so when we look closely after this momentary downtrend, we can see that there is a reaction at around this area here. There's a reaction here. Price seems not to break below the previous demand. We are looking or anticipating to buy at this area. So we see this candle here, this particular candle here of interest is a hammer. It's indicating aggressive buying pressure. This is a hammer right here. Okay, that is a hammer candlestick pattern. All right, we will just type there. Okay, so that is a hammer right there, and it's indicating aggressive buying pressure at that point with the long wick at the bottom. All right, so after the close of that hammer, we are going to place our buy order just at the close of that candle and place our stop loss below the long wick of that hammer. All right, because that is where liquidity is, and then we target a 1 to 2 or 1 to 3 or even 1 to 4 risk to reward ratio to the upside, like in that case. So you can see that the momentary downtrend has reversed after that hammer candlestick pattern, indicating aggressive buying pressure to the upside. So we see that there is a reversal of price back to the upside. So that is a rise in buying pressure after that hammer candlestick pattern has been formed. So from a downtrend to an uptrend, okay, so from a downtrend to an uptrend, that's a reversal from the support or demand zone. Hammer candlestick pattern as an indication or an extra layer of confirmation at demand zone or even at the trend line to indicate aggressive buying pressure, all right, to the upside. So you place your buy order after the close of that hammer. You can see this uptrend here, all right. That is a clear uptrend. The market is forming higher highs, okay? It's forming higher highs, higher lows, higher highs, higher high in this case, then a higher low, then a higher high, and then it forms this higher low here. And this higher low is interesting because it is a hammer. That red candle there is a hammer, all right? At that point, this candle here is a hammer. This one here is a hammer. So that hammer there is actually coinciding with a break of structure. As you can see, there's a break of structure here, BOS. There's also break of structure right here, okay? So break of structure happens in every trending market. You have higher highs, higher lows forming break of structure, okay? So this is a break of structure, BOS here. And then there is also break of structure right there, okay, as the market forms higher highs and higher lows. But you can see that in this case, there is, after this retracement, after this momentary retracement down to the downside, okay, right here to retest this previous break of structure, which has turned into support in this case, all right, to the upside. Because it is an uptrend, we are looking to buy. So we are looking for any candlestick pattern to confirm our entry, okay? So we see that there is a hammer candlestick pattern right here. So after that hammer candlestick pattern closes, we place our buy position, okay? We open our buy position, place our stop loss just below the wick, the long wick of that candlestick pattern, which is the hammer, and then we can continue our uptrend, all right, with our 1 to 2 risk to reward ratio to this point here. So this trade would be a winner at a 1 to 2 risk to reward ratio. As you can see, this is another example, an uptrend. You can see an uptrend with this trend line. You draw your trend line, all right? You can see the first touch over here, okay? And then you see you have several touches along that line, okay? This is an uptrending market, okay? So now we are anticipating another touch After this retracement, we are anticipating another touch and a confirmation for us to go long, okay, for us to buy, because this is an uptrend. But we also have a breakout, okay? We have a breakout of this zone here, okay? Out of this zone here, we are anticipating a breakout of this area, okay? A breakout of this zone, okay? So now this becomes an ascending triangle, okay? Ascending triangle. So this is an ascending triangle pattern. You can see how you can find more confirmation and confluence even with your hammer candlestick pattern. So you have resistance, okay, and then a more resistance, and then a breakout at this zone, and then you have a retest, but you don't have much confirmation around this zone until we see this hammer, that red hammer right there, okay? There's a hammer right there. I'll just expand this, magnify this so that you can see. There is a hammer right there, okay? So after that red hammer, you can see the impulsive move to the upside. That's where you would enter your trade for a long position, okay? After that hammer, you place your stop loss just below the hammer and target a 1-to-2 or 1-to-3 risk to reward ratio to the upside. Okay, so you can see how I use all these tools in confluence so that you have more confidence placing your trade when you see the hammer, all right, as a bullish indicator. So with that red hammer, you would have your confirmation even after the breakout of this triangle. All right, let's move on. So now the second candlestick pattern that you need to look at is a shooting star. It also indicates imminent reversal to the downside. Let's look at this. The price opens. This is the opening price right here. Okay, so this candle opens right here, but the buyers push the price even higher to this point here. Okay, so this is buying pressure, pushing the price up to this point. But the sellers there are more selling orders in this structure. All right, so the sellers are more in the market. Sellers come in and they push this price even lower beyond the opening price to close at the lowest price down here. Okay, so it indicates that there is more selling pressure than buying pressure. There is more selling pressure than buying pressure. So it's the opposite, like it's like the opposite of the hammer. So here you have more selling pressure than buying pressure. That is why the sellers push the price even lower. Even if the buyers pushed it higher, the sellers pushed it even lower. All right, let me illustrate it here. Okay, so let's say the market is rallying to the upside. Okay, so you have an uptrend. You are forming higher highs, higher lows. Okay, the market is trending upwards, and then you get to a resistance zone right here. Okay, so that is your resistance zone. Okay, so you have resistance or supply here. So usually at resistance or supply, traders are looking to sell. So but when you see a candlestick, a shooting star forming at resistance like this, okay, when you see a shooting star forming at resistance like this, now this shooting star indicates more selling pressure, that sellers are coming into the market with more orders to sell. All right, and those who had bought this particular asset are also exiting their orders because they anticipate the price to drop even further. All right, so this candle, if it forms at a supply or resistance zone, you are looking at selling. Okay, you are looking at selling at this point. So you would place your sell order and target lower prices down here, and you would place your stop loss just above your stop loss would be just above the wick of this shooting star. But it is good, it is much stronger a signal when you use it in confluence with support and resistance, or even trend lines. Sometimes you can find a trend line like passing through here. So this trend line will be added confluence for you to actually consider selling even further down. All right, so it will give you more confidence to sell if you have a trend line and you have resistance and supply zone, and then you see this kind of candle, the shooting star. It gives you more confidence at that point to sell. All right, so this indicates more selling what? More selling pressure. So you are looking to sell with a shooting star. All right, so don't use it alone. Use it in confluence with the resistance and supply zones, okay, and also trend lines if you like. So it's much stronger that way. As you can see, this is also an uptrend. This is an uptrend and uptrending market. And then we have a resistance level over here or supply zone. This is a resistance or supply. I'll just type that out. Resistance or supply zone. So the general understanding is that when the price gets to a resistance, we are looking to sell because the market price is at a premium and it is very attractive to sell at that point. So at a resistance, we are looking to sell. That is the supply zone. All right, as you can see, there is the first resistance here, the first touch is here, and then the second touch here. But then on the third touch, we see our candle of interest, which is a shooting star. You can see that particular candle, the red one, this one here, that is a shooting star. As you can see, it has a long wick at the top. Okay, it has a long wick at the top here, and then a small body like an inverted hammer. So it is reacting to the resistance or supply zone. All right, so we are looking to sell after that, after the close of that shooting star. All right, I'll just mark that out as a shooting star over here. That's our shooting star. Okay, candlestick. It's a single candlestick, and it looks like that. So after the close of that candlestick, we're looking to sell at this point and place our stop loss just above the long wick of that shooting star. Okay, just above the long wick of that shooting star, and we are targeting a 1 to 2 or 1 to 3 or 1 to 4 risk to reward ratio all the way to the downside. So we can continue stacking trades all the way to the downside. So this is how you would trade the shooting star. Once you see the shooting star at resistance or supply zone, or even at trend lines, bounce off at trend lines to reverse the trend from an uptrend. Okay, like in this case, this was an uptrend here, and now we are looking at a reversal to the downside. This is a downtrend. All right, this would be a downtrend. So we got that confirmation to the downtrend, showing a reversal of the trend using the shooting star. All right, so the shooting star can be like a part of the confluence with this resistance level or trend lines to indicate a downward reversal. You can also use a shooting star just to continue the downtrend. Let's say, as you can see, this is a downtrend, right? This is a downtrend, but to continue this downtrend, you can see that there was a break below here. Okay, this is a break below this level here. All right, there was a break below and a break below here, and there was that retest there. Okay, but then at the retest here, we can see that there is a shooting star here, the blue one. All right, so that shooting star can also serve as a confirmation. Okay, can be an indicator of a continuation of this trend to the downside right here. Okay, so we can place our trade just at the close of that shooting star also to continue that trend to the downside, and we can place our stop loss just above the wick of that shooting star to continue our trend to the downside. So it can serve as a confirmation to continue the downtrend, or it can also be, and this can also be a resistance level. Okay, a pivot level where it was previously support here. Here it was previously support. Okay, but then it turned to a resistance over here. Okay, so this turns to a resistance at this point. So this is like a pivot zone. Okay. Okay, this is a pivot, all right, where support, okay, previous support turns to resistance. So at resistance still, when you see this kind of candlestick pattern forming, which is a shooting star, this blue one here, you can actually place your sell orders here just in this fashion to continue this trend. Here is another example of the shooting star. You can actually see that this is a pivot zone or now turned resistance zone. You can see this is a resistance or supply zone now. Okay. So that would be our resistance or supply zone. As you can see, there's several touches. It's the first touch here. That's the second touch over there. And then we can see our candle of interest here. This would be our shooting star, the blue one. You can see it right there. Okay, that candle is a shooting star. That is our shooting star right there. So we would place our sell order at the close of that shooting star. Top loss just above the wick of that shooting star, and then we would target all the way down here. Okay, and continue the trend to the downside. As you can see, the drop after that shooting star formed right there. It dropped all the way to the downside. This is another example of a shooting star. As you can see at the resistance here, all right, this is a clear resistance level. Price is not able to break above this level. Okay, at least 3 times we can see a resistance. So this becomes a supply zone. Typically traders are looking to sell at this resistance or supply zone. Why is it called a supply zone? Because most traders actually placing sell orders here. So there's a lot of liquidity up here or selling orders at this point. All right. So our candle of interest, we can see this is a shooting star, this red candle here. So just see what happens after this shooting star. All right. You would sell at this point, place your stop loss just above the shooting star wick. All right. And you can target all the way down here. All right. So you can see that downward momentum immediately after the shooting star occurs. You can see that this is an uptrend. Okay, this is a clear uptrend. We shall turn that to blue, an uptrend. Okay, this is a clear uptrend. And as you can see right here, there is a shooting star candlestick pattern. Okay, that is our shooting star right there. Immediately that shooting star appears, we can see a reversal to the downside of the trend. Okay, that is a complete reversal to the downside. So this becomes a downtrend. Okay, so when this shooting star appears, especially at the resistance or supply zone, it often indicates an imminent reversal. All right, so the third one is the engulfing candle. 2 types of engulfing candlestick patterns. There is a bullish engulfing candlestick pattern, which we are going to start with, and then there is a bearish engulfing candlestick pattern. So the first one here is the bullish engulfing candlestick pattern. It looks more like this. All right, so it looks more like this. Okay, so this pattern has 2 candles in it, unlike the previous ones which we have looked at as single candles, but this one, it has 2 candles in it. The first one is a small red candle, and then the second one is a very large green or bullish candle. And the first one is inside. Okay, its open and close are inside the second the open and close of the second bullish candle. You have to note that. All right, so it is important that you realize that there is a gap between the close of the first candle. This is the first candle, this is the second candle. Okay, so there has to be this gap here. There has to be a gap. All right, this candle the first candle cannot close below the second candle. It has to be inside. So the engulfing candle is the green candle. The bullish candle engulfs the first candle. The second one has to totally engulf the first candle. That's why it's called a bullish engulfing. It totally covers the first candle. Okay, so the bullish candle closes above previous candles open. So this first candle opens here. This candle has to close above the first candle's open. The second candle opens lower than the first candle's close. All right, so that has to be understood clearly. Okay, for it to qualify as a bullish engulfing candlestick pattern, there have to be two candles, and the second one has to totally engulf the first one, as you can see here. So let me illustrate that on the screen here. So, and this bullish engulfing candlestick pattern indicates bullish momentum to the upside. So you are looking to buy when you see this candlestick pattern. Usually a reversal, it indicates reversal also, or continuation. It depends where you have seen it. All right, so let's say it's a downtrending market like this. All right, and then you get to a support zone. Okay, let's say you get to support. All right, so let's say you get to support. So this is a support zone or demand zone. Okay, and usually at demand or support zone, you are looking to buy. All right, you are looking to buy. So now, as you're looking to buy, you see this candlestick pattern forming. Let's say you see a candlestick pattern like this forming. Next one you see is quite aggressive like that. Okay, this is the first candle and this is the second candle. Okay, but the second candle totally engulfs the first candle. All right, so its open is below this candle's close, the first candle's close, and its close is above the first candle's open. All right, so now when this forms here at support or demand zone, and let's say you also have another confluence of let's say you have a trend line passing through here, so that's another confluence adding on to this pattern. Okay, so now you are looking to buy at the close of this bullish candle here, so you would consider buying at the close of that candle to continue the trend to the upside. All right, so when you see this candle at support or demand zone, you are looking at buying. All right, similarly, when even if this was not a trend, even if this was like a continuation, okay, let's say it is an uptrending market like that. Okay, breaking structure, this is a break of structure, BOS. Okay, and this is break of structure, okay, BOS. Okay, so the market is rallying to the upside, and then there is a retracement in this fashion to this point here. So there is a retracement and you are looking at buying to continue this trend to the upside. When this candlestick pattern forms here, let's say this candlestick pattern forms here, okay, you have a small red candle forming here, have another blue candle forming like this. Okay, a very aggressive candle forming like that. So you have this bullish engulfing candlestick forming at this point. All right, so that is your confirmation at a break of structure. So now you have here both a resistance level and then support is forming here. So this is becomes a pivot zone. So you confirm you're at the break of structure to continue this trend to the upside. You buy from this point. Okay, after that candlestick pattern forms the bullish engulfing candle, so you continue your trend to the upside. All right, so you confirm your buy at this point. All right, you can also use the Fibonacci retracement tool for more confluence, or even the trend line for more confluence to continue your trade to the upside. Take a look at this. All right, this was a downtrend at first, but when the price got here around this point here, we can see a complete reversal of the trend to the upside. Okay, and we can see why, because there is a bullish engulfing candlestick pattern right here. This is a bullish engulfing candlestick pattern right there. Okay, that is a bullish engulfing candlestick pattern. You can see the first candle is red and it is totally engulfed by the second blue candle, which is very much bullish. Okay, indicating an imminent reversal of this trend from a downtrend to an uptrend at this point. Okay, so after the bullish candle closes, you would actually take your buy order at that point and put your stop loss just below that bullish candle and target all the way up 1 to 3 or 1 to 4 risk to reward ratio, and you'd actually win this trade. Okay, so this is a complete reversal from the downtrend, okay, to an uptrend, like that in that case. So this bullish engulfing candlestick pattern often indicates an imminent reversal to the upside. It's a very powerful indicator, especially when this happens at support or demand zone. All right. As you can see here, also another illustration here on the chart, you can see that this is a previous demand zone. Okay, this is our demand zone. You can see that clearly before the price could not break lower than here. It's the first test here. You can see these spikes, they show bullish momentum, okay, or buyers coming into the market around this demand zone. So you can expect around here that there are so many buy orders around here. So when the price got around here, that's why you see after this, the price got to this demand zone, there is this kind of reaction. So now we are anticipating to buy after the retest here of this demand zone. So now we are looking for our candlestick patterns to confirm entry, and we can see our bullish engulfing candlestick pattern right here. Okay, this one here is our bullish engulfing candlestick pattern, engulfing blue candle, okay, that covers the very first red candle. Okay, it is very imposing and it shows aggressive buying pressure coming into the market. So at the close of that blue candle, you can place your buy order, okay, and place your stop loss just below that demand zone or support zone, or just below the bullish engulfing candle, and target a 1 to 2 or 1 to 3 risk to reward ratio to the upside. So as you can see, the reversal of that trend from the demand zone to the upside. Okay, so this bullish engulfing candlestick pattern can be more useful if you use it in confluence with support areas and also trend lines. If it bounces off a trend line, it is also very, very, very useful. Like in this case, if you had a trend line running across here, okay, you would actually have more confluence in that manner. Okay, if you have a trend line that is running here, so that it gives you more confluence around this zone, reacting to this zone to the upside. So the bearish engulfing candlestick pattern looks like this. Okay, the first candle is bullish, it's green, it opens at the bottom here, closes here at the top. All right. So the next one is a bearish candle. It opens, okay, it opens above the close of the first candle. So this is the first candle, this is the second candle. So the second candle, the condition for it to be a bearish engulfing candlestick pattern, the second candle has to be bearish, and it must be larger, significantly larger than the first candle. It must open, must be above the close of the first candle, okay, and its closing price must be below the open of the first candle. And this pattern forms usually at a resistance level. It indicates a possible reversal to the downside. Okay, let's say there is an uptrend in this fashion, higher highs, higher lows. Okay, and then this candlestick forms at a resistance. Okay, so there is resistance up here, okay, which is also called a supply zone. All right, so most traders are looking to sell at a supply or resistance zone. All right, and those who had bought are looking to actually exit their positions, which will lead this asset price to drop. All right, so when this candlestick pattern forms around here, so let's say you have this candlestick forming here, candlestick pattern forming here, okay, and you have the red one, totally engulfing the first candle. So this first candle has to be totally engulfed by the second candle. So when this candlestick pattern forms here, the bearish engulfing candlestick pattern forms here at resistance, it's indicating eminent bearish momentum. that more sellers are in the market than buyers. There is more selling pressure than buying pressure. So you get ready to sell at resistance when you see this bearish engulfing candlestick pattern. All right. In confluence with resistance and supply zones, or even trend lines. You can have a trend line probably crossing through here, and you are looking to sell from below here to the downside. So you are looking to sell this asset, okay, from that point to the downside, okay, and you'll usually place your stop loss just above the bearish candle right there, so that your stop loss will be there safely up there. You can see that there is a resistance here also. Okay, we are going to identify where our bearish engulfing candlestick pattern is. As you know, a bearish engulfing candlestick pattern is comprised of two candlesticks, all right, the bearish and the bullish, but the bearish candle totally engulfs the bullish candle. That means the bullish candle is the first one you see, okay, but it is totally engulfed by the bearish candle, usually at a resistance or supply zone. First touch there, and then when the price returned here, it dropped again. So that's a clear resistance zone. But you can see what happens in the third instance here, okay? This is our candlestick pattern right here. This is the bearish engulfing candlestick pattern. You can see the first candle. You can see the first candle here, totally inside the second candle, which is the bearish candle. The bearish candle is much bigger, and it totally engulfs the first blue candle, okay? The first blue candle is totally inside the second red bearish candle. So that is your indication that there is selling pressure at that point. So you can place your sell order just at the close of that bearish engulfing candle and consider holding it all the way down below, okay? That bearish engulfing candlestick pattern indicates bearish momentum to the downside. So as you can see, immediately after the bearish engulfing candlestick pattern, you can see momentum increase, okay, to the downside. Okay, selling pressure increases to the downside. So I would place my stop loss just above the wick, or just above the bearish red candle, all right, that engulfs the first blue candle. Okay, so that's a bearish engulfing candlestick pattern. All right, so you can use it especially at resistance. Okay, it's especially stronger at resistance or at even trend lines in a downtrend. Here is another example of a bearish engulfing candlestick pattern. To continue this trend after the retest here, break of structure to the downside. So you want to continue this downtrend after the break below, and there is a retest here. At the retest here, we have our bearish engulfing candlestick pattern right there. Okay, you can see our bearish engulfing candlestick pattern right there, and you can see that the red candle totally engulfs the previous blue candle is much smaller. All right, so you want to continue that downtrend. At the close of that bearish engulfing candle, you want to place your sell order and place your stop loss just above the bearish engulfing candlestick, and you can see that you'd actually win this trade big, okay, to continue the previous downtrend. All right, so you are just continuing this previous downtrend after the break and retest, the break of structure right there. So this would be the BOS. This can also be used to confirm entries at the retest or break of structure, retest at the break of structure to the downside, as you can see clearly here. Okay, so this is our bearish engulfing candlestick pattern right there.